I'm here today with Dr. Erik Berglof to discuss the European Bank for Reconstruction Development's 2013 transition report, Stuck in Transition, with a question mark. Dr. Berglof is the chief economist of the EBRD, and he's also a member of the governing board of the Institute for New Economic Thinking. Welcome, Erik.
Thanks for having me.
So this report builds that bridge between politics and economics and talks about institutional evolution, institutional reform, and the interaction. What inspired you to take on this topic as an institution?
Yeah, there were a number of things. One is that over the last decade or so, we have seen really every year the same pattern, very little movement in terms of reform in Central Europe and Eastern Europe. But also, of course, the events in North Africa, in the Middle East, seeing the very strong emphasis on political reform, on opening up the political system and the links that it had to economic reform. So these two things together, and of course also that EBRD has in its mandate to promote democracy. So we sort of wanted to take this head on and try to look at what is the connection and what can be done to promote economic and political reforms together.
So the chicken and the egg, what causes what? Is political reform necessary for economic reform, or do economic reforms then reveal the possibility for more political reform?
What we emphasize here very much that it is a two-way street. So you can, and this is the basis for EBRD's constitution, is that by implementing economic reforms, we will also get political reforms in the long term. And what we look at the evidence for this in the region that we have worked in now for over 20 years, and we see quite a lot of evidence. It's not reassured at all, but over the long term, the likelihood that economic reforms will lead to political reform is very strong. And of course it has to do with opening up markets, supporting entry of new parts of society, building a middle class, and all those things help to promote political reforms. But we also see that given a certain political system, you can do economic reforms, and there are many ways in which you can improve your economic institutions even if you are sort of locked in for now into a particular political system.
In political and economic folklore, there's always this notion lurking in the background that you need an authoritarian leader to implement the tough reforms and put you on the positive trajectory. Does your report explore that notion, that is it a necessary condition?
No, so I think this is exactly what we find is not true in our region. I'm not saying that it could never be the case. Of course, leaders matter, but in our region there is very little evidence that having an autocratic leader will help you implement economic reforms. If anything, it goes the other way, and actually there's quite a lot of evidence that it goes the other way. To really get sustainable economic improvements, or improvements in economic institutions, you also need to work on the political institutions.
One of the implications of your report is that integration, both in financial and goods trade, seem to be associated with the capacity for institutional reform and refinement. China doesn't have a lot of financial integration at this point, but the goods trade and foreign direct investment technology transfer seems to be rather robust. How do you see, just more generally, the role of integration and how it relates and correlates with these things?
So what we do in this report, we look at the difference in the quality of institutions between those that have the best institutions and those have the worst institutions, and we try to explain what factors determine that. And their integration, as you say, both financial integration and trade integration matters a great deal. Maybe trade integration, we sort of understood that, you know, opening up your borders, allowing trade would help somehow to build both economic institutions, because you sort of import institutions that way. But what is very important, and in particular I would say in Eastern Europe, is the financial integration, the fact that you had these banks that helped develop financial systems. So those financial systems allowed people to come into the economy. It improved financial access. It allowed for a middle class, allowed for an entrepreneurial class to come to the fore, and that helped both economic and political reforms.
There's a great deal of focus around the world now on skills, skill development, what we call human capital. How does that relate to these challenges?
So I think actually investments in human capital is a way out of these transition traps. And what is absolutely critical, and we show this in the report, is that the value of your investments in human capital, when you go and educate yourself, you get a secondary education, you get to go to university, the value of those skills are very much influenced by the quality of economic institutions. So, by improving the economic institutions, you improve the incentives of people to get an education. And that is a way to break out, I argue, and we argue in the report, of these transition traps.
So when you look at the cross-section of countries under study in your report, what are some of the, notable things that you derive? Which countries are stellar examples, which get stuck?
So of course, we do both the cross-country analysis, but what we really find very informative to understand these linkages between economic and political institutions is to look at case studies as well. One thing one can look at is if there were some large reversals in political institutions, what impact did that have on economic reform? And the largest, perhaps, reversal in the region is Belarus, which in the early 90s developed quite a vibrant democratic system with many political parties, free elections and so on, but then reversed back into a very authoritarian and non-democratic environment. And if you take countries that are at the same level of economic institutions, the same quality of economic institutions in the early 90s, and compare them to Belarus today, you can see that Belarus has not made any progress in terms of economic institutional quality, while these other countries have made very significant improvement. Of course, it's not a proof, but it's sort of an indication that political institutions matter, that there is a link.
I'm tempted to have a vision that everybody's on a trajectory, slower or faster, towards a level of maturity. But many people are concerned now that the developed countries, the members of the European Union, the United States, Japan, are actually regressing.
Yeah,
I'm
glad you bring that, because it's something that is actually quite important in the report. So we should celebrate what the countries, particularly in Central Europe and the Baltics, have done in terms of reform in the 90s and the early 2000s. It's truly remarkable. It's probably, I would argue, the most dramatic economic and political institutional changes in history in that short time space. But when you then look, sort of starting 2003, 2004, you see this leveling off of economic reforms while they have, of course, maintaining quite high levels of political institution, quality of political institutions. But then comes the crisis, and what you see in the crisis, and it is, I think, a quite interesting feature, you can see that the support for markets and support for democracy is very much affected in these more advanced transition countries in Central Europe, in the EU members. And while you see, if you look at Central Asia and the Caucasus, the impact of the crisis is almost the opposite. So you can ask yourself, why is that? Well, I think we identify three factors that matter. One is the size of the shocks. Of course, Central Europe were much more integrated, both financially and economically. They had a more, you would expect more impact on the attitudes of people. The other thing, and they were much less, or much more affected than the countries in Central Asia, because they were less integrated, were not part of the global economy to the same extent. But then if you look at the second factor that matter is the size of the transitional recession in the 90s. So the countries that had very deep transitional recessions for example, in the Baltics, but also in the former Soviet Union. For them, this very large shock that came from the outside, and with very significant impact on people's lives in terms of their finances, in terms of having jobs and so on, that shock was so small compared to what they had experienced before. So there was less of an impact. But the third factor, which I think is perhaps the most interesting one, and the one that one needs to really reflect on what's behind it, is that there seems to be an incumbency effect. So that if you are in a country with well-developed markets, you blame the markets if you don't have a job, or if you cannot.
Whatever the system is to blame.
You blame the banks because you can't get a loan and so on. But in Eastern Europe, further out in the Central Asia, Caucasus, you want more markets because you think that's the way. You want more financial system to allow the insurance function of the financial system and so on. So this impact of the financial crisis has had very different impacts on different parts of our region, and we see now also in Central Europe, and particularly in Central Europe, not so much in the Baltics, a reversal in economic reforms. You can see, for example, in pension reforms that they have moved away from the sort of private pension fund system back into pay-as-you-go system, or funded systems into pay-as-you-go systems. You can see that there are also, in terms of financial reforms, there are some regressive examples of reforms. So, and you see the energy sector, they are reversing previous reforms. So that, I think, is a reflection of the impact of the crisis and sort of the attribution of problems that came out of the crisis to the economic system you have.
Big agenda item for the world and for China is the opening of their financial markets, the development and maturation of their domestic financial institutions, and the integration with the world convertibility of their currency over time. Right now, when one looks in the Chinese economy, there appear to be massive distortions, relative prices, big real estate bubbles, and what have you. And you have state-controlled financial institutions. How do you envision the unfolding of financial sector reform and integration, modernization in China? And how do you predict that will affect the politics and society as a whole?
First of all, I think these are very important changes going on in the economic sphere in China. So it's not only about the financial opening, yes, but it's also about many other aspects that I think are movements forward in terms of the changes in the political system and the changes in the economic system.
Well, I must say, from the standpoint of the Institute for New Economic Thinking, you're painting a picture as what you might call an imaginative guide to young economists, particularly in the emerging markets around the world. And it allows them to envision the challenge, the policies, what constitutes well-being in a different framework than a mechanical or technocratic framework, but it's still rigorous. So, congratulations.
Thank you. Thank you. And I think when we wrote this report, it was very much that we had in mind, to inspire thinkers and economists and political scientists in those countries to really get engaged and try to understand these links in the specific context of individual countries. I think that is a tremendous challenge and something that, if we can play any role in fostering that debate and fostering environments that encourage that debate, that would be a fantastic.
People always ask me, what's new economic thinking? And you lead by example. So
thank you very much.
Thank you very much.
Thanks.